The broadcast is now starting. All attendees are in listen-only mode.
Hi everybody, my name is Manoj Abhichandani and I'm going to present on total superannuation balance, and Happy New Year to most of you. This is my first presentation for 2018 years, and I intend to have these presentations at least twice a month for 2018. Where you booked from, please look forward to emails from me where you'll be notified of new presentations coming up in the year. It's going to be a very interesting year, being the first year after total superannuation balance being implemented, and a carry forward into the new year where we'll see the rollover of the effect of 1.6 million pensions in the new year. I will just wait for a couple of more minutes. I can see a lot of people are coming on board, and I'm just going to wait for a couple of more minutes. Right. All right. So let's kick into it and talk about total superannuation balance. Now, before we start with the presentation, some points which I would like to discuss is that the topic is also about home loans and super contributions, because a new thing has happened from 1st of July, that is, employees can also contribute into super, and this is the first time it has happened since 1st of July 2000 and 17, and what we need to see the effect of it. And you will see quite a few sales people, especially from insurance companies, trying to target employees to entice them to salary sacrifice and contribute more into super. We'll talk more about it later, but just for some housekeeping issues. If you cannot hear me, then on your panel there would be a phone number provided. I cannot do anything better than what I am currently. So what you will need to do is you will need to ring that number, and you will be provided a PIN, and you'll have to enter that PIN, and only then you will be able to hear me. Now, I've got a very strong internet connection. It's possible that you do not have a good internet connection, that your audio is not coming out correctly, so you'll have to phone that number. The second point is about a handout. You will see in your panel, I have uploaded two files, and you can download those files, and one of those files is today's presentation, and an Excel sheet, because we will be talking about comparing uh, home loan contribution, or paying off the home loan against contributing into super. Now, the next is that my presentation may, irk some of the issues, um, and you may, some of the things which I say may not be very clear. So I request you to add your questions in the panel provided, and after my presentation, I will read through all those questions. And those who have not, those who haven't asked a question, sometimes it's a good idea to stay around and see what other people are asking and how I am answering those questions. Now, my presentation today will last about 45 to 50 minutes, and I will allow 10 minutes for the question time right after the end of my presentation. Okay, so today we are talking about total superannuation balance of a member, and everything is based on contributions, because your superannuation balance goes up provided something is contributed into super. We all know that the concessional contribution cap is now, from 1st of July 2017, is now reduced to 25,000. So one thing which we need to keep an eye on, there could be some clients or you yourself would have contributed something extra in June 2017 as a reserving strategy. So basically they get counted towards the next year's cap amount. So just watch out if anybody has contributed or talking about contributions of 25,000, whether an extra amount was contributed in June last year for the current year. Um, the requirement that you had to derive less than 10% of income from employment sources has now been abolished. That means full-time employees will be able to make a contribution into super. This was available earlier only as a salary sacrifice. You had to talk to your employer and make an arrangement with their employer. That is not necessary anymore. What employees can do is, from after tax salary, they can contribute and claim a tax deduction in their income tax returns. Just a reminder that ages between 65 to 74 will still need a work test in order to make a contribution into super. Now, if you're thinking that you will contribute for your kids, there are some special rules, because kids can only, under 18s, can only claim against business income or work income. So if you are distributing any trust distributions, they may not be able to claim a deduction against those incomes coming to them. So just as a reminder about the work test, it is applicable to only those who are over 65, and between 66 and 69, member and employer contributions are all affected. And one thing which you will notice is probably different than what you have heard about. My thinking is that the 40-hour in 30-day period should have been completed uh, to make a contribution. So 40 hours have not finished on the 1st and 2nd of July of any year. So if you're a super fund auditor, just watch out if those contributions, non-concessional contributions, have come in at that point of time. So what you will see, that a person has contributed whereas he hasn't worked. So that could be an issue as well. So this is something which you need to resolve with the trustees of the fund if contributions are made before 40 hours of the financial year have actually been completed. For those who are 75 and over, we know that only the 9.5% compulsory superannuation contributions can be made, and those which are based on award if they are more than 9.5%. So the benefits out of these new rules are that employees can contribute and super can be topped up from a savings account. If a member has a savings account, then before 30th of June they can make a contribution, or they can make a contribution from a home loan, or if a member has an offset account, then they can draw some money from the offset account. So what is really advantageous is that we don't have to go through a salary sacrifice arrangement for the whole year. A contribution can be made on the 28th or 29th of June for the whole year, and then the concessional contribution can be topped up. So a member can basically control the timing and the amount so that they don't go over the $25,000 cap amount if they don't intend to. Um, what we need to do is, if we are making these type of contributions, there is a form, NAT 71121. We can fill up that form under section 29170. Sometimes a superannuation fund will have their own form. You can even fill up their forms. Some super entities, BT and some others which I've noticed, they have an online form. You can fill up those forms. So the conditions to claim it as a tax deduction is that you must be member of the fund and you haven't commenced an income stream from that amount. So that means that you have contributed that amount and the amount is in the fund, and the fund has not started distributing that money to you as an income stream, because the income stream is based on the 85%, that is after the 15% tax which is deducted from a concessional contribution amount. And there is no spouse splitting contributions form lodged. I'm going to talk about spouse splitting a bit later, and those who are not aware of it, just very briefly, any concessional contributions made in the previous year can be split to your spouse in the current year, but only concessional contributions can be split, and only 85% of previous year's contributions can be split. But we're going to talk about it a bit more later on. Now, the next thing is, to claim this deduction, you have to put in the amount at the appropriate place in the income tax return as a deduction. Now, what happens after you claim a tax deduction? The individual taxable income will be reduced, and that will also reduce the amount of tax which you pay, and you get a refund if your employer is paying tax at the rate which is higher, that is the PAYG withholding tax. That would be refunded to you when you lodge your income tax return. And whatever you have contributed into super, it will be, once you lodge your 29170 declaration, it will be included in the fund's income tax return, and the fund is obliged to pay 15% tax on all concessional contributions. Now, if you are on low income, then it's possible that you don't pay any tax, and that is limited to the first $500, and it's called listo. So what will happen is, if your adjusted taxable income is below 37,000, up to 15% or up to $500, the government will send the money directly to the tax office. The only condition here is that you must lodge a tax return. If you do not lodge a tax return, although your income is below 37,000, this monies are not paid to your super. So lodging a tax return is very important. Now, I get asked this question: how much can you contribute? There is no limit on how much you can contribute. So the $25,000 cap amount is the cap amount uh, at which point no income is included in your income tax return. So let's say if you make a deduction of 35,000, you make a contribution of 35,000, including the SG employer contributions. So it's 10,000 above the cap amount of 25,000. The extra 10,000 is taxed in your hands, and uh, once you lodge a tax return, the tax office will marry up the member statements which it receives from the superannuation fund, and then it realizes that 10,000 extra has been contributed. Then the tax office will include that extra 10,000 in your assessable income, and it will ask you to pay tax on that $10,000. Now you can ask the fund where you have contributed to release that extra tax which you have to pay, or you can pay that tax from other sources if required. So more contributions can be contributed. More than 25,000 can be contributed into super, and that's very interesting, because some of you could be in higher income, and this could be a way to reduce your tax, or to contribute more money so that your total superannuation balance is increased. And this is useful for those people who are intending to commence a pension. Now, any amounts above the 25,000 get added in your income, but the net effect is that you have a higher amount inside of super, and the following year it is taxed only at 15%, and capital gain tax taxed at 10% if the asset is held for more than 1 year. So if your intention is to build up your super pretty quickly, and if you're on high income, one of the things which you can do is to contribute more yourself, even if you are a salaried person. Now, this was not available in previous years. So let's take an example of someone who was a full-time employee, and they sold an investment property, and in that year they had high income, so they wanted to contribute more money. They simply could not contribute more money other than ask the employer for 100% salary sacrifice or more, but now they will be able to do that. Now, the effects are that any amounts claimed will be, included in your income tax. The Division 293 tax is something which you should worry about, because that is now reduced from 300,000 to 250,000. So what it means is that if your adjustable taxable income is more than 250,000, whatever you contribute or whatever your employer contributes, you will pay an additional 15% tax on those super contributions. So that means if your adjustable taxable income, now by adjustable taxable income, I mean not only your taxable income but also the superannuation contributions which you make into super. So if that is more than 250, all the contributions where you are claiming a tax reduction will be subject to 30% tax and not 15% tax. Now, one thing more you should be aware of, that if you decide to contribute more than the 9.5%, it gets included in your reportable super contributions, and there are some offsets and medical levy surcharge, and there are some government benefits which can get affected as well. So one should be very careful in planning on how much they should contribute into super. Now, just a little bit more on the Division 2933 tax. So the threshold has been reduced from 1st of July 2017. And when you have unusually high income, now this could be trust distributions coming, possibly because there is a sale of an asset in that trust, or it could be your personal gain, or there could be a termination payment where you are ceasing an employment and you're receiving more than normal income in that financial year. So you have to be very wary on how the result is going to be. Now, next thing is the contribution can also be not only for yourself, but it can also be for your spouse, and the threshold has been increased. So Obviously, the government is a bit concerned about where some family members, it's usually the female gender, which has to, because of family reasons, be away from work. So what they're saying is that if you contribute for your spouse, you can get a rebate of $540,000, but the contributions are limited to $3,000. So the intention here is that more spouses would be eligible for these type of contributions. Now, we all know that there is another type of contribution what a person can make to be included in the total superannuation balance, and that is the non-concessional contributions. The bad news is that from 1st of July, the cap amount is 100,000 down from 180,000. And those over 65, they cannot avail the bring forward rule, and those below 65 can do that. So basically, 3 years contributions can be made in 1 year. But there are some special rules, and I'm going to talk about that in the next slide. Those who are 65 and over can only contribute $100,000. Now, the special rules are that if your total superannuation balance reaches a certain level, then you cannot make any non-concessional contributions. So if you already have 1.6 million in your super, then you will not be allowed to make any non-concessional contributions, including the $100,000, which is the cap amount. Now, the way the tax office looks at your total superannuation balance, it is the balance of 30th June of the previous year. So any contributions which are made this year are first tested against the total superannuation balance of 30th June, which you have declared in the income tax return. Every superannuation income tax return has a member account, and it has a opening balance and a closing balance, where in the tax return the administrator has to disclose new contributions made and income credited to the member each year, and it has a closing balance. So that is the balance which gets carried forward into the next year and tested against new non-concessional contributions. So a superannuation balance of previous 30th June, if it is 1.3 million, because it is less than 1.3, you can bring forward next 3 years contribution. This is assuming that you are 65 years or under, can go up to 300,000, and between 1.3 to 1.4. So if it is less than 1.4, you can still contribute up to 300,000. But if it is 1.4 million and over, then you can contribute, because it's 2 years test, it's 1.6 million, you can contribute only 100,000. Now you will notice that this balance is 1.5, the contribution is only 100,000. Now the balance of the member gets increased by the unrealized gain of the assets which the super fund owns. Now I'm looking at a situation of a self-managed super fund. A self-managed super fund will prepare a set of accounts, and all the income earned by the member will be credited to the member account. But there is a lot of income which is not earned by the fund. It is unrealized. That is the increase in market value of the assets. So if the increase in market value of the asset is tipping over the balance from 1.6 to higher than 1.6, then no contributions allowed. But when you value these assets, the market values are pretty easy to determine when it is a listed asset, let's say listed on the stock exchange. But sometimes the super fund owns some other types of assets, like let's say property, or it owns shares in an unlisted company, or units in an unlisted unit trust, or units in a related unlisted trust. So what you are allowed to do is that in the valuation, if you include the selling costs, then it is possible that you could reduce the balance just marginally below. So if you were between 1.4 and 1.5, you can actually, from 100,000, you can double your contributions to 200,000. So you, as an administrator, should be discussing these things. If you're an accountant, you should be discussing these items, whether the client needs to contribute any non-concessional, and you would do that closer to age 60 rather than closer to age 65, because they get 5 years to use the bring forward rule. And sometimes the clients are thinking of downsizing their house, selling their house, and moving to a smaller place. And that is when they will have that extra money, and which can be contributed into the self-managed super fund. So this is what you should be having a conversation with your client about. Now, what is total superannuation balance, and how it is measured? For most clients, it will be an accumulation account. So whatever is their accumulation account is their superannuation account, and any rollovers and any structured settlement, less any structured settlement contributions. I'm going to talk about a little bit more about what is structured settlement contributions. But firstly, um, total superannuation balance is the transfer balance of the member, that is the net credits and the net debits. And we all know when you commence a pension, you commence a transfer balance account of that member. So when you credit that member, so let's say your balance could be 1 million and you've credited the transfer balance account of that member. So in future years, if income is higher in the pension account than the pension payment, so income could be say 7 or 8%, and pension payments could be 4%. So it's quite logical to have the pension account actually higher than what it was started with. So we ignore those amounts in the total superannuation balance calculations. So we just look at what was the transfer balance at the commencement of the pension. And then we look at situations where the pensioner also has an accumulation account. And I'm assuming it'll be very unlikely that somebody would have less than 1.6 million and is of pensionable age and not working and will have an accumulation account. So, in other words, those who have 1.6 million would like to maximize their pension. So, because they're not working, so all the income earned by the pension account becomes tax free. So, it's very unlikely they will have an accumulation account if they don't have 1.6 million. It's only those people who have more than 1.6 million will have an accumulation account. So the way it is measured is you look at the transfer balance, usually the amount used to commence the pension, then the accumulation account. The accumulation account can go up and down based on unrealized gain, and so can the pension account. So we talked about uh, checking the selling cost of each and every asset before actually crediting the unrealized gain. Now, when you credit unrealized gain to an accumulation account, you must also consider the cost of 15% tax payable or 10% tax payable in valuing the asset. So it's possible to have a reduced total superannuation balance based on the valuation. So it's the first time, that is the 30th June 2017 accounts, we should think about these things, because in previous years you could have as much as you wanted in your pension account, but because there are certain rules which restricts the transfer balance to the 1.6 limits, and it's possible that in future member would have a debit because he has withdrawn more than the minimum amount. It is possible that you could move more money into pension phase because of a higher withdrawal. So it's quite important that the assets should be valued at net realizable value instead of the net, or rather net market realizable value than the net market selling value. Structured settlements are those settlements from personal injury claims. They must be contributed within 90 days into the super fund, and once receipted, the whole idea is that instead of getting a lump sum as a personal injury, you can contribute into super and then commence a pension from super and get income and the principal amount paid out to you instead of the injury claim being paid to you in lump sum. Now, Uh, there are certain rules. If you do not contribute the cap amount up to the 5 years, you can accumulate the short paid and you can carry forward the cap amount. So let's say um, if you contribute only 15,000 and the cap amount is 25,000, you have short contributed 10,000, you can actually carry forward the short which you have contributed, the 10,000, up to a maximum of 5 years. This is going to commence from 1st of July 2018, so it's a little bit early that we are talking about it, because the first time we will realize that somebody has contributed short is on 30th of June 2019. So we can skip this and not worry about it because it's not relevant for the time being. Next is that if you contribute more uh, as as concessional contribution, anything above 25,000, they are tested against the non-concessional contributions to super. So let's say if the person is over 65 and he has worked for 40 hours in 30 days period, they cannot contribute more than $125,000. The reason they cannot, as concessional contributions, the reason they cannot contribute more than $125,000 is because they don't only have to worry about the concessional contribution cap amount. Anything above the concessional cap amount is tested against the non-concessional cap amount. The non-concessional cap amount is $100,000, and because they are over 65, they cannot use the bring forward rule. So the maximum they can ever contribute, if total superannuation balance allows them, is $125,000. So anyone who is below 65 years old, the same rules apply, that they will not be able to contribute more than $325,000 if the bring forward rule has not been triggered, because any concessional contribution above the cap amount, that is the 25,000, is tested against the non-concessional cap amount, the non-concessional cap amount maximum being 300,000. So any contribution above 325,000 is possibly going to be returned by the member, by the fund to the member. Now, the total superannuation balance is also used to segregate pension assets in the fund. So, to commence a pension, to commence a balance transfer cap amount. So, that is when we look at the total superannuation balance, and that is the next important thing for you, is to check the total superannuation balance of each and every member. But total superannuation balance is not calculated when we are making any CGT, small business contributions, which are about 1.2 million. So you could have a balance of your super more than 1.6 million, and you could still contribute into super. Even the structured payments are not counted, so you can contribute more than 1.6 million. The co-contributions also do not check the total superannuation balance. If there is a co-contribution entitlement, the government will contribute into the self-managed super fund, or to any super fund. And the new downsizes contributions, they do not look at the total superannuation balance. Those people who have sold a home can also claim ignoring how much money they have in super. I just want to put in a disclaimer here because the last time I spoke about on how much you can contribute into super, and the last time I talked about not contributing or not paying off the home loan, I got a letter from ASIC with the assumptions that I was making. Um, I was giving financial advice to people. I just want to make sure that I'm not doing that here. And I know it's a little bit of a small font, but I'm sure you can hear me that if you think that I'm giving you legal advice, if you think I'm giving you tax advice, if you think I'm giving you financial advice from here on, then the control is in your hand. You can simply close the browser and just exit this webinar right now, because what I'm doing now is I'm just giving you some examples, and I'm giving you a strategy where certain contributions can be made into super, which is construed as financial advice. And the benefit is that you or your clients can actually reduce your tax. And it can be also constitute as legal advice. That is not my intention. My intention is only for educational purposes only, and nothing else. Um, if you're staying online, that means you have agreed that you are watching this presentation only for education purposes only. Now, some of the contributions strategies which you can implement for yourself and for your clients is splitting super with your spouse. Now, it's quite possible because you cannot contribute more than 1.6 million. Once you reach 1.6 million, non-concessional contributions cannot be contributed into super. You cannot have a transfer balance cap of more than 1.6 million. That means when you commence a pension, only 1.6 million can commence a pension, can be in pension phase. So if you see that your spouse has a different balance than yours, what you can do is you can split concessional contributions. You cannot split non-concessional contributions. You can split concessional contributions with your spouse who has a lower balance, and 85% of previous year's concessional contributions. So if you contributed anything between 1st of July 2016 to 30th June 2017, the first time you can credit your spouse account is on the 1st of July 2017. So any contributions of previous year can be split with your spouse this year. Last year, the cap amount was 30,000. So 85% of 30,000 can be split with your spouse in the current year on 1st of July 2017. Now, this could be very helpful because it's possible that one member is below 1.3 million transfer balance cap, and we saw that a maximum 300,000 can be contributed. So this could be really helpful if one member wants to avail the bring forward rules, and where there's a huge discrepancy. And there are many situations there were discrepancies because there was an age difference between members. Like myself, I'm 4 years older than my spouse. So I was splitting whatever my wife contributed to myself. And the reason I did that is because I was going to reach the preservation age first. So it was beneficial that all the contributions were in my name, because I could put in maximum amount into contribution, a maximum amount into pension phase, and all my money could be tax free. Now the whole thing is reversed. Um, the benefit of transferring to my name was that not only her contributions were coming to me, and because I had a higher balance, regulation 5.03 of the SIS regulations talk about that all the income of the fund should be distributed to all members under the fair and reasonable basis. So because I had more balance, I obviously got more income as well. So my balance climbed very quickly, whereas whatever my wife contributed, she lost it. 85% of it to me and 15% to the government. So her balance actually stayed where it was, and it was marginally increased by the income and the unrealized gain which the fund was crediting to her account. But now it is reversed, because the reason why it is reversed is because I can only put 1.6 million into pension phase, so I have a very high balance. So my intention is, because my spouse's balance is only 200, 300,000, my intention would be and she doesn't have so many years into going into pension phase, so she has only 6 or 7 years to go into pension age. So what my intention should be is to withdraw the money, a recontribution strategy. That is, once I reach the pension age, I would withdraw maybe my accumulation account once I'm over 60, and then give that money to my spouse, and my spouse can do the bring forward rule, but or can benefit from the bring forward rule, provided her balance is 1.3 million or lower. So valuation of assets is very important for unrealized gain purposes. So the second strategy is obviously very similar to spouse splitting, because it's not only splitting the concessional contributions, which is 85% of the amount contributed in the previous year. A recontribution strategy is basically withdrawing. For that to happen, I must be over 60, because any taxable component being withdrawn below I am 60 are included in my tax. And I should not be working at 60. So what happens is that I withdraw the money out, the cash comes out of the fund, and then it goes back in. And now you must remember that cannot happen with a journal entry. So there should be money actually coming out of the fund and then being contributed. Now, the second benefit is, and I put it very loosely here, is ability to leave death benefits in the fund. Uh, this line by itself can be a 2-hour webinar. The reason is that in case of my death, the money must be cashed out, and that's what Income Tax Act talks about. Money has to be paid out. The SIS regulation, SIS Act 6.21A also talks about it, that a death benefit must be cashed out, but it can be reverted. A reversionary pension can be paid. So what will happen is that my spouse will commute her pension and commute it to an accumulation account and absorb the reversion from my pension to herself. And if that reversion is applicable, then she'll be able to retain her amount also into the fund, and the higher is her amount, the better it is. So spouse splitting should now be used, or recontribution strategy should now be used to balance the two members' accounts. So my next mission would be is, but it'll be probably 6 to 9 years. Here, every 3 years, she can only put 300,000, and there is a huge balance difference. My balance being much higher. So even if I give her, so let's say she's got only 3 times bring forward rule, she can only put in 900, whereas my balance is far more than 900 above the 1.6 million, and you will have clients like that. So this recontribution strategy is limitized. So it's something which you cannot use forever and ever to balance the members. So that means upon my death, whenever that happens, uh, there will be some money coming out of super, because she will not be able to reverse, or she will may not have an accumulation account in the pension fund. Well, there are some ideas on how you can do that. How you can manage that risk is that you withdraw the money out after death and then contribute into kids' name, because if your spouse has already got 1.6 million, you can only contribute into an accumulation account. So the purpose is, if it is going to an accumulation account, it might as well be in the kids accumulation account, because it will be taxed at 15%. But the benefit of being it into your spouse's accumulation account is because it can be withdrawn. That is, your spouse has reached the preservation age. The problem with it being contributed in the kids' accumulation account is that you will have to wait till the kids have actually reached the preservation age. So this is something which you need to think about and then plan for your clients. The third thing is the new legislated downsizer contributions. It is applicable from 1st of July 2018. The trust deed of trustdeed.com.au does not have that provision. It will be included in the next update, which is going to happen in April 2018. This downsizer contributions are applicable from 1st of July 2018, and what it does is anyone can make over 65 can make a 300,000 contribution. There is no work test. It has to be uh, put into super within 90 days of the sale. Now, when they say sale, they're talking about settlement date. That is, within 90 days, it must be inside super, and it's only on sale of one principal place of residence. So, if you have two uh, principal place of residence, you have an issue there. You can only claim it in one, and it should be owned for 10 years. Now, this 10-year period, I was looking at the legislation, and what I thought was that it is one settlement to another settlement. So I guess you have to look at, if your clients are thinking of using this benefit, is to make sure that they have the settlement of the date when they actually purchased their home. The member must notify the trustee of the fund that it is a downsizer contribution, and it's quite possible that over 65, contributing a higher amount, otherwise the trustee would refund the money because it's more than $100,000 due to the work test situation. The sad part is that whatever monies are contributed, it is included in the asset test. So if your clients are thinking of getting a government pension, then the bad news is that this money is contributed will be included in their total assets. So there's no escape there. A spouse can also contribute. So husband and wife, even if the name of the spouse is not on the title, you can contribute up to $600,000. Um, Now, when you contribute into super, the contribution can now be a little bit controlled. Like I said earlier, when it was in the hands of the employer, it was only salary sacrifice. Although you could vary the salary sacrifice, like take May and June salary 100%, so you could time it in such a manner. So, but now you can contribute at any time. So that means you can basically contribute on the 28th of June, and you could, as long as you had the money, so you have to look at the 9.5% and then look at the balance and then contribute the rest of the money to match up the 25,000 cap amount. Just a repeat, concessional contribution is not tested against the total superannuation balance, so it does not matter how much you have in super. So you may have 5 million, you can still contribute 25,000 into super because it's a concessional contribution and not a non-concessional contribution. I've already spoken about the excess concessional contribution is counted towards the non-concessional. Hence, it's tested against the total superannuation balance of 1.6 million. So we'll have to see what excess amount you have contributed and whether or not your total superannuation balance actually allows you to contribute the excess amount or not. So those who are already over 1.6 million, and then they are limited basically by $25,000. They cannot claim any excess amount because the excess amount will be counted towards non-concessional contributions, and non-concessional contributions are not allowed because your total balance is over 1.6 million. Now, if you are an accountant, you may know this. There may be some clients who may not know that. and they may have contributed from 1st of July 2017 till now. So under those situation, what you need to do is you need to ask the clients, and this is a problem because you could be end of the year administrator. You won't find out till they give you the set of accounts. So it'll be a good idea that you write to your clients that do not contribute. I mean, those members, if you've done 30th of June accounts, 30th of June 2017 accounts, it's a good idea to write to them and tell them, sorry, you cannot contribute because your total superannuation balance is now more than 1.6 million. Now, method of contribution, we know how salary sacrifice works. It's an arrangement between your employer and yourself. You can always pay from your offset loan account, basically take the money out and contribute. So that's how simple it is. And or you can create a home loan too, and home loan 2 account. And this is very interesting because usually people pay if they've borrowed to live in a house, they usually pay a mortgage to the bank. Well, I haven't paid any money to the bank for the last 15 years, and I've still continued to live in my house. So what I've done is basically I've created another account, a home loan 2 account, and I'll show you how that works and how you can actually not pay the bank at all. So I'm going to use a very simple example, but just to understand how the monthly salary sacrifice and lump sum payments from the offset account works. So I'm assuming that the home loan which you are paying is 4%. I'm paying 3.9. So I guess that's the market condition. And I'm assuming that whatever saving you are going to achieve is what the fund is going to earn. So if you don't pay the home loan, you will pay 4% after tax. And that is the same income which the fund will earn after tax. So it'll earn about almost 5%, so 15% of 5%. So you'll still have a net return of 4%. So we're just ignoring the interest because whatever is contributed in super is also earning money. So the savings on tax are is just a taxable income. So the tax rate is 21%, including Medicare levy. Tax in super is 15%. The saving is 6%. So if you look at common income, between 37,000 and 180, or the median income, the income or the savings is basically 19 or say 20%. If you look at the mean salary or the average salary in Australia. So I don't know why people won't do that because it's so easy to do. Contribute into super and save 20%. So whatever you contribute, you literally save 20%. And somehow I cannot understand the difference between a superannuation balance and my home because both of them are for retirement. So if my house value is going to grow, it doesn't matter whether I have a loan or not. So if I have borrowed 100%, and if the suburb which I live in grows by 3%, I've borrowed 100%, my house is going to grow by 3%. But if I own the house fully, so I don't owe anything to the bank, my suburb grows by 3%, my house is going to grow by 3%. So it does not matter how you finance it. If houses of values of houses are going to grow, they will grow independent of how they are funded, how they have been purchased. And that's very important because when you reach preservation age, when you reach 65, it's quite possible that you will downsize. So you can simply sell the house and pay off the loan. So, there are techniques available. So I don't know why, if you save 20% of putting more money into super, why won't you do it? So if husband and wife are there and they can contribute up to 50,000, including the 9.5%, I just simply don't understand why any couple won't do that. And the only reason which I can think of, the only reason why they won't do it is they don't have the money to contribute. And the answer to that is capitalize your interest and not pay anything to the bank. And this is how it works. And I'm going to talk about, and this should be done very, very carefully. I'm going to use an example, a very simple, very easy example to explain how it works, the creation of a second loan account, and how you can actually capitalize the home loan interest which you're paying. So today I looked at canstar.com.au. I checked a Westpac 5-year fixed principal plus interest. The reason I looked at principal and interest is because the government has restricted the banks to give out loans which are interest only. Because if it was possible I mean, under interest only loan, this works very, very nicely, and it works very nicely in principal as well, principal and interest. And you will see my example on how well it works in interest only, and that's what the government doesn't want you to do by restricting the banks by how much interest only loans they can issue. And by the way, if you check the bank, they will tell you that interest only loans, the interest rates are higher, whereas principal and interest rates are a bit lower. If you're paying less than 4.39%, that means it's a variable rate. So I've used a 5-year fixed rate. So the rate is not changing. So we have held that constant. And the loan amount, I'm assuming that it is, let's say the person, Mark and Mary, are 45 and 42, and I'll show you in the next slide what I'm trying to achieve here. I've checked the monthly repayments are 2,500 on a 30-year loan. If you look at your handout area in your panel, there's a handout I've given you a spreadsheet. So the spreadsheet will prove to you that the monthly repayments are at 4.39% on a standard 30-year loan on 500,000 amount is 2,500. I've assumed the loan value is 1 million, and because if you're 45 and I'm speaking from Sydney where we've had consecutive since 2011, 6 years gain of almost 40%. So I'm assuming that you bought the property 6 years back for 600,000 and the loan amount is still 500,000, and the value has risen from 600,000 to 1 million. And the average home now in Sydney is 1 million. So I'm just taking that value that the house was purchased 5 or 6 years back, and the LVR is 80%. So if the loan is 500, you have further borrowing capacity of 300. LVR at 80% means that you can borrow up to 800,000. So we have a loan of 500, so we can borrow another 300. So if you look at the spreadsheet, loan one after 60 payments, that is monthly payments, will be 455,000. And loan two, I'll explain you what I mean by loan two. What you do is you go to the bank and say, I want one more loan. And the 2,500, which is the monthly payment, I'm not going to pay you that money. So loan number two, because we have the borrowing capacity to 300, so you start another loan, and from the second loan, 2,500, or rather the installment of the first loan will be paid by loan number two. So what will happen is that every month, when the loan installment is due for the first loan, a principal and interest component of 2,500 will be debited to loan number two and credited to loan number one. And because you're paying the principal down, the interest will increase the 500, but the principal is reducing the balance. So after 5 years, your balance will actually be lower, will be 455,000. And I've proven to it in the Excel sheet which I've given to you. For the time being, let's assume that these figures are right. so that we can proceed. So loan number two after 60 payments, so 2,500 multiplied by 60 payments is 150. So what we're talking about is interest on interest. We're capitalizing interest. So my loan will be 168,000. So the total of two loans after 5 years will be 168,000 plus the 455,000, which I've reduced, is 623,000. So basically, uh, the loan, the original loan on today's date is 500. After 5 years, if I implement this strategy, my total loan will be 623. So it will increase by 123,000. So literally, you live in your own house without paying a cent to the bank for next 5 years. However, instead of owing to the bank 500, now you owe them 623,000. So that's what I'm talking about. So what do you do with the extra money? So let's look at Mark and Mary. So Mark is 45 and Mary is 42. And I'm not trying to judge Mark and Mary. I'm just trying to look at the median wages of male and female, and the taxable income is 80,000 and 60,000 for Mary. Total is 140. I looked at the tax amount, and you can check these figures later on because I've given you my presentation. For the moment, let's assume that these figures are right. So tax is 19,000. So you're left with 60,000 cash, 47,000 cash, and 108,000 cash together, which is per month so much, and per week $2,000 and $90. Now, because you have a home loan to pay, principal plus interest of 2,000, weekly 577, you're actually reduced to $1,513 per week after paying off the home loan. So a normal Joe Blow is living, let's say if you've got two kids, you'll hardly have any change left, and you've just upgraded a car or something, you could have some car payments or whatever. So you're just living by, and you're just getting by. You're not saving any money. You're not getting richer. Of course, your house is going up in value, but you're just paying off your home, and it'll take you 30 years to pay off. So by the time Mark is 75, his loan will be paid off. We are not doing anything, and although what we are doing is we're just basing our retirement on only one thing, that is the employer 9.5%. And there have been a lot of studies everywhere that the 9.5% is not enough for a comfortable retirement. So I've just used a figure that we had 100,000 to begin with in super at the bottom, and the 9.5% on the taxable income is being paid by the employer. It's not going to be enough by the time Mark or Mary decide to retire. They will be um, relying partly on government handouts. So what you can do, or what you should be doing, is actually implementing some sort of a salary sacrifice or home loan too. And the way the home loan 2 works, and if you look at what I've done out here, uh, I've done a home loan 2 plus the salary sacrifice arrangement. I've done a combination of two strategies. So I'm not going to pay anything to the bank. So I don't have that liability to the bank. So I'm just going to change the figures over here. So I'm going to do a salary sacrifice of 15,000. So I'm going to contribute 30,000 more into super, and my taxable income gets reduced. And if you're an accountant, you will check that the tax gets reduced, and if the tax gets reduced, the net income gets reduced. It's 89,000. The net cash per month, it's 7441, but you will see that per week. Now this can be played with. I mean, I'm not saying that you should do 30,000, because um, if you really look at it, the employer contribution together So we had the superannuation balance. So employer contributions were 13,300. So altogether it's 20,700. There is still scope to increase the salary sacrifice. So here, Mark has contributed 15,000. The employer has put in 7,600. It's 22,600. There is still a gap of 2,400. So we can salary sacrifice a little bit more if we want. And that's also possible. And this is what you really need to sit down with your client and say, here you are. I'm going to increase the money. So if you look at the previous slide, they had $1,513 per week to live on, and they were paying off the home loan. That's right, and they had no money to retire on. Here, what they have done is they're salary sacrificing, but they're paying nothing to the bank, and they have more money to live on. So I did some computations for you, and all those computations are in the spreadsheet, and you can have fun with the spreadsheet afterwards, and you will see that the total of the two loans, the way we looked at it in the previous slide, we worked it out that the total of the two loans will be 623. So the increase in the loan is 123,000. So I'm just using the same figures here. So the total of the two loans is 623. The increase in loan is 123,000. And now I'm assuming that the super is growing by 4.39%. So I don't know. I don't know whether your super can grow at 4.39% or not. I can only talk about how much my super fund grew by. I got almost 40% return. And how I got 40% return is probably subject for another webinar. But assuming all superannuation funds paid a double digit return, and so achieving 4.39% should not be much of an issue. So my calculations are based on that the super is growing by 4.3%, 39%. That is the interest rates which we are paying. Now, increase in super due to salary sacrifice, because we are paying 2,500 every year. So 2,500 every month. So those contributions plus the income I have in my calculation, whatever we contributed, the 2,500, I have taken 15% out as tax on contributions. And then I have added 4.39% only to the 85% component, the leftover after paying the 15% tax. So your super is actually increased because of the salary sacrifice. This is just the salary sacrifice component, the 2,000, the 500 which you are contributing, the 30,000 salary contributions which I'm talking about. So 30,000 is 2,500 a month. Uh, so you've contributed. So what you will see that over a 5-year period, although there has been an increase in your home loan, there has been a huge increase in your super balance on achieving only 4.39%. So if I change the rate to 40%, like my super fund, this increase in super would be huge. Or if I put it even at 10%, the increase in super again will be huge. So I'll let you play around with the spreadsheet. But what I'm trying to say is that if you're ready to retire at this point of time, although there has been an increase, you still benefit. And not only the benefit is in the super balance, you have a better lifestyle. Because remember in the previous slide, when we were paying off the home loan, we had only 1,513 to live with. And now we have $1,717 to live with. Now, this is not magic. All I'm trying to do is trying to explain to you that contributions are taxed at 15%, and there is a saving of 20% overall if you are able to contribute into super. So that's why we've got 53,000 over a 260 week period, which is 5 years. So the saving is 204 per week. So altogether you save 72,000 only if you receive 4.39%. If you get 10%, I played around with the figure, you are probably about $180,000 better off. So because it's cumulative. It's 10% every year, every year, every year. So I also looked at the superannuation balance. The joint superannuation balance when we started, this is now 5 years later, what would be the situation? So if you exclude the salary sacrifice, that is, if you just trust your employer to contribute, and the difference is 142, so 250 plus 142, 142 here. So 250 plus 250,000 plus 142 will give you 392. So if you include the salary sacrifice, it is a sizable amount. So what will happen after 5 years? If from 1 million the house grows only at inflation rate at 3%, which is cumulative growth, your value would be 1.159. So your 80% LVR will allow you to do it again anyway. But even if your loan is 123, even if it is 1 million, you can still continue to have a second 5 year stint and a third or a fourth 5 year stint till you are 60 years old. And if you do that, and the cumulative effect, and the depending on how much your super can earn, and super tax or tax on super can be reduced, and it can be reduced dramatically because the effect of imputation credit. It's quite possible that all the money is invested in dividend paying shares, or you could have a property, and a brand new property you could claim depreciation on it, and that depreciation is a deductible expense in your super. So it's possible that the contributions actually don't pay 15% tax. So the super balance could actually be huge. Now this is just a simple exercise what you should be doing. Now I must remind you that most of these discussions are on how much you can contribute to super, how much you're allowed to contribute into super, and if you are only a tax agent, um, any talk about contributions to super have since 1st of July 2016 become financial advice, and you will need a limited license or a full-fledged license if you're talking about stuff like this, that is reducing your home loan or not paying off the home loan at all, and changing the way you look at it altogether. I cannot talk about others. All I can talk about is my own self. I have been very successful in doing it this way. Uh, I purchased a home in 2011, and the previous home, I have not paid a cent to the bank, and I still owe money to the bank, and I'm not going to pay anything to the bank. And I have seen my superannuation balance balloon over this period of growth in property over the last 15 to 20 odd years, and have a sizable superannuation balance. Um, I want to thank you for your attention, and I welcome you to ask questions. I note that I've crossed my time limit, but I'll hang out for another 5 minutes if you had any questions. Most of the questions are to do with the presentation, the handout. If you look at your panel, you can download this presentation, uh, and you can download the Excel sheet where I have done these calculations. Feel free to do so. I think it was a very simple presentation and was very straightforward and very easy for you to understand. There are not any technical questions. I can see that, and I would like to wait 1 minute, and I will then uh, close the close the screen. Now, for some reason, I can see there's a question there. You're not able to download the PowerPoint presentation. You're more than happy to just send an email out to me, and or you can contact trustdeed.com.au, and we'll be very happy to send you out the presentation and the Excel sheet. Thank you for being with me, and I'm coming up with some very interesting concepts for 2018. I'm in the phase where I'm in the giving back to the community, and I hope you'll enjoy listening to my other presentations as well. Thank you very much. Bye for now.